Hi folks, welcome back to the second part of our video for this question. And what we're going to do here is we're going to focus on preparing the statement of comprehensive income for Blake under the equity method, assuming still that there's significant influence for years 5 and 6. And you can see here I've also asked you to calculate the balance sheet account on Blake's balance sheet for the investment in Sturgis for both years 5 and 6. And then in the second part of the question, I've asked you to assume that Blake is private and chose to use the cost method, and then to do their separate entity statement of income for both years 5 and 6. And then the last part of the question is to assume that Blake wants to show the lowest debt to equity ratio. If they had a choice, would they prefer to use the cost method or the equity method? So this is what our second video will focus on. So let's see if we can go back to the solution here and look at the statements of comprehensive income. You recall that in the question I gave you the sales revenue and you calculated the equity method income from their continuing operations on an after-tax basis, which was $12,950. That was their portion of the equity income of Sturgis that they could pick up. So notice here that this will come to $1,012,950. Again, notice that we've separated the equity method income from continuing operations from any discontinued operations income from Sturgis, as well in this case we also had OCI that Sturgis had booked. So we continued to separate out equity method income from the regular operations that Blake picked up from Sturgis. We separate it from any discontinued operation that Sturgis had and any OCI that Sturgis had on Blake's statement of comprehensive income, and that we only pick up their part. So these are all separate, so that's why they're highlighted. Data regarding the operating expenses and income tax expense were given to you in the question. So you can kind of see here that we're setting it up sort of the way we did in our prerequisite course, where we have discontinued operation, the associates portion that we pick up, added to our income before discontinued operations, and then after we calculate net income, we show our share of the associates OCI that we pick up, and we come up with comprehensive income of $576,400. Similarly, here in year 6, we're doing the exact same thing. The only difference in this part for year 6 is that Sturgis, the associate, didn't have any discontinued operation. So we're only picking up our share of the continuing operations after tax of Sturgis, and again, our share of Sturgis's OCI. Now, in the second part of Part B, we also asked you to Part A, third part of Part A, we asked you to calculate the value of the investment in Sturgis at the end of year 5. So what did we do? Actually, we went back to the entries, and we know that we made an entry when we first purchased Sturgis for $1,850,000. So that starts off being our true cost. To that, in year 5, we added our share of the equity method income. We also added in our OCI, share of the OCI that Sturgis had booked, as well as the discontinued operations gain. One last thing that we would have done is we would have made a journal entry because Sturgis declared I think it was a $74,000 dividend. Yeah. And that dividend was declared, and 25% of that was $18,500. And don't forget, under the equity method, we credit the investment in Sturgis for any dividend we get from that associate company. So now we wind up with an ending balance in the investment account in Sturgis at the end of year 5 on Blake's balance sheet at $1,847,900. Similarly, if we start with that balance at the end of year 5, we add in our share of the equity of the income from continuing operations after tax of Sturgis. We also add in the amount that we picked up from OCI, as well as reduce the investment in Sturgis on Blake's balance sheet for the value of the dividend that we got from Sturgis. And that gives us a new balance of $1,873,800 at this point. Okay. Now, if we were doing this under ASPE, don't forget, under the cost method, we would not take in our share of the earnings of Sturgis, and we would not pick up our share of any discontinued operation or OCI that Sturgis booked, because again we're using the cost method. So the idea here is the investment stays at cost, it doesn't get adjusted. So in this case, that's why I'm saying there's no entries made for taking in our share of the OCI of the associate. And I guess I could have gone further to say we're not even taking in our share of the associate's income or any DO. So we set up the investment under the cost method, just like we did under the equity method. We set it up at cost, but here any dividend income we get is just credited to dividend, right? Which is still $18,500. All right. In year 6, again, in year 5, notice we're not making any other adjustments to the investment in Sturgis account. Here in year 6, again, to take in the dividend, we do not credit the investment in Sturgis on Blake's balance sheet as we did for the equity method, because we don't consider it a return on investment. What we're really doing here is we're looking at crediting what we know from our prerequisite courses, which is just dividend income. And again, we're 25% of that $75,000. So now if we were doing the statements of income, and I called it a statement of income because notice we don't have any comprehensive income here, unless, Blake had some separately, but they didn't, okay? So I'm just making an income statement here for years 5 and 6. So to the sales revenue that Blake had for year 5, we add the dividend income to get total revenue, deduct our operating expenses at $300,000 and our income tax expense, and we get net income of $578,500. Similarly here, when we look at the statement of income for year 6, we do the same thing. We add the dividend income that we booked in year 6 to the sales revenue that Blake had, which was in this case $1.3 million, deduct the operating expenses and income tax expense that they booked, and that gives us $738,500. Now, the last part of the question says, if Blake preferred or wanted to show the lowest debt to equity ratio, which method would they choose? Well, obviously, if they have a choice, they must be reporting under ASPE. So in this case, we would prefer to use the equity method. And the logic should be fairly clear at this point, given your knowledge of ratios. If you think about it, equity is changed by the amount of the investment income that Blake takes in from its investment in Sturgis. Well, if you went back and tracked over years 5 and year 6, all of the equity they took in over that 2-year period, you'd see that in year 1 they took in $12,950. They also took in $600 from the discontinued operation. We also had some OCI in there at some point in time of $2,850, and then we also had a similar thing going on in year 6. If you add up all of that amount of income, it really comes to $60,800. That's what they took in equity as a result of their investment in Sturgis. But don't forget, if they had done it under the cost basis, they would have only taken in the dividend times 2, $18,500 per year for 2 years at $37,000. And don't forget, when you're calculating a debt to equity ratio, it's debt over equity. So the method you use, whether it's cost or equity method, doesn't affect your debt, but it will affect your equity. So wherever the equity position is the highest, that's going to make that debt to equity ratio fraction smaller. So in our case, if we wanted to show the smallest debt to equity ratio, we would pick the equity method to use because it provides equity of $60,800, whereas under the cost method, it would only provide equity of $37,000. So I hope you found this video helpful.